What's going on, everyone? Charlie here. We're going to talk about the RSF factor threshold. So in the ASF factor, we had language that made them basically include things like fail to deliver and securities lending. And, they left out the shorts. So that's where the RSF factor comes in. So we're going to talk about the thresholds and disclosure required around the RSF factor. It's the other part that derives that NSFR, or the net stable funding ratio, that must be a 1.0 or higher, or administrative enforcement could happen. So this is the disclosure form. I'm going to leave this PowerPoint below in the description so you can take a look. I'm not going to read everything verbatim. I'm just going to go over important parts. This is the disclosure template. You can see here there's quite a bit to it. I'll let you read that. But it says right here, a covered depository institution holding company, U.S. intermediate holding company, or covered non-bank company must publicly disclose the information required by this subpart in the format provided in Table 1 to this paragraph. Now, if you look at the previous one, and I apologize, I actually didn't give a side-by-side comparison. You can find it online. It only had average unweighted amount versus average weighted amount. There was no time frame. So the difference here is we have a lot more categories. We have a lot of new defined terms, and we actually have a different selection of categories based on time frame. So RSF factors, again, a factor of 100%, all that means is the asset or exposure needs to be entirely financed by stable funding because it is liquid. This is, for instance, the case for all loans to financial institutions with a residual maturity of 12 months or more. An RSF factor of 0 applies to fully liquid and unencumbered assets. In Table 1 right here, paragraph B, required stable funding adjustment percentages. You can see this right here. These are different categories of board-regulated institutions that you can find in a previous video that I made for this series. And by the way, I always leave the playlists with all of this in it at the end of each video. So if you're unsure about what I'm talking about in some area, I've basically covered all of it. You just go to this playlist and you can find the video that's relevant. So again, before we get into the thresholds, a brokered reciprocal deposit, that's been redefined by switching the words around. It was called a reciprocal broker, or reciprocated broker deposit before, but now it's brokered reciprocal deposit. And basically, they've changed it to where now it's received through a deposit placement network other than a counterparty or a customer. So now instead of going to that, it goes through a deposit placement network on a reciprocal basis, meaning that if someone makes a big deposit, on the other end, they've got to make the same deposit to make a net zero. Basically right here, deposit placement network means a network in which an insured depository institution participates together with other insured depository institutions for the processing and receipt of reciprocal deposits. Now, basically, it requires that a bank collateralize or otherwise secure the deposit with treasuries or ultra-safe, highly liquid government securities, which is an added cost to the banks for them to do this. So the different thresholds. What makes up a 0% RSF factor? Well, basically because it's fully liquid, anything currency and coin related, anything a cash item in the process of collection, reserve bank balance, or other claim on a reserve bank that matures less than 6 months. And it's common language that anything maturing less than 6 months will fall underneath the 50% RSF factor. It can also be a level 1 liquid asset that's not described in these first few paragraphs here, which is cash, central bank reserves, and certain marketable securities backed by sovereigns and central banks, among others. So 5 and 15%. For the 5%, it just has to be the undrawn amount of a committed credit facility or committed liquidity facility, is the entire unused amount of the facility that could be drawn upon within 1 year of the calculation date under the governing agreement. For the 15% RSF factor, it basically is level 2A liquid assets or certain government securities, covered bonds, and corporate debt securities. 50% level 2B assets, basically corporate bonds, residential mortgage-backed securities, and equities that meet certain conditions, and the conditions are all going to be based around time frame, such as 6 months or more, but less than 1 year. Now, a secured lending transaction basically is a transaction that's subject to legally binding agreement of the calculation date and gives a cash obligation of a counterparty to the national bank or savings association that is secured under law by a lien on assets owned by that counterparty. And this, of course, gives priority over the assets in the event that the counterparty enters into receivership, bankruptcy, insolvency, liquidation, resolution, or similar proceedings, including reverse repo and securities borrowing transactions. Unsecured wholesale lending means a liability or general obligation of a wholesale customer counterparty to the institution that is not a secured lending transaction or a security. It says that unsecured wholesale lending does not include asset exchanges. Now here is the 85%. Basically, it's assigned to a retail mortgage that matures 1 year or more, secured lending transaction that matures 1 year or more from the calculation date, and a publicly traded common equity share that is not HQLA, a security other than a publicly traded common equity share that matures 1 year or more after calculation date and is not HQLA. So 100%, this is where it gets cool, because 100% are unencumbered assets, of course, and basically they're non-performing assets. Any non-performing asset that is past due by more than 90 days or non-accrual will be assigned this 100% RSF factor, meaning it is illiquid. Now, if you read this right here, 100% also falls on off-balance sheet rehypothecated assets. When an NSFR liability of a board-regulated institution is secured by an off-balance sheet asset or results from the board-regulated institution selling an off-balance sheet asset, for instance, in the case of a short sale, other than off-balance sheet asset received by the board institution as variation margin under a derivative transaction. If the board-regulated institution received the off-balance sheet asset under a lending transaction, an RSF factor is assigned to the lending transaction as if it were encumbered for the longer of the remaining maturity of the NSFR liability, and 2, any other encumbrance period applicable to the lending transaction. So I like how they put specifically, for instance, in the case of a short sale. So there you have it. That's basically it. I'll leave this PowerPoint below. It says right here, if the board-regulated institution did not receive the off-balance sheet asset under a lending transaction or asset exchange, an RSF factor is assigned to the on-balance sheet asset resulting from the rehypothecation of the off-balance sheet asset, as if the on-balance sheet asset were encumbered for the longer of the remaining maturity or any other encumbrance period applicable. So take that for what it's worth. I'm very, very excited for tomorrow. See what happens.